Hello, my friends. Brett Patterson coming at you from not the financial capital of the West. Brian is joining us from the financial capital of the West. How are we, Brian?
Doing good. Doing
Yeah.
good. Yeah.
Spencer from the great land northward.
What is up, Bretter? Good to see you.
Spencer's excited because Louis Gohmert was just traded to the San Diego Padres or something like that.
That's exactly right. You got it right on, Brett.
It's Rudy Gobert, right, to the Minnesota Timberwolves. Apparently, Spencer, he's smart out there.
We're out there.
Nailed it. Anyway, everyone, thanks for listening. We're coming at different places today. I'm a little bit under the weather, as you can probably tell in how my voice sounds. So staying away from Brian and Spencer today. Stay safe, stay home. Right, Brian?
That's right.
But we have an important topic today that we want to discuss. And it's something that we get asked about a lot from friends, from clients, family. I've even been asked by kids, what's with the gas prices? So everybody notices it. And it's the big bear in the room right now. And I know that it's supposed to be the big elephant in the room, right, Brian? I think
That's right.
the big elephant in the room. We're going to call it the big bear in the room because this market sucks. And it is a bear market and it sucks to go through. And so what's causing it? What's causing the stock market to go to be bearish? And so we're going to share my screen today, share some thoughts, share some charts, some statistics. So let me do that now. And I first want to bring up, where are we year to date? So this is returns as of July 1st of the year 2022. The S&P 500 as of now is down 19.74%, highlighted on the right-hand side of my screen. The NASDAQ down almost 30%, down 29.08%. And the corporate bond index, which we don't talk about a lot, but it's important to understand, is down 10.3%. So what does all that mean? Well, that means that it's been a tough year. In fact, it's been so tough. On my screen, you're going to see a very, very conservative portfolio. A portfolio of 60% stock, 40% bonds. That return of that really conservative portfolio, it's down 18% this year because that big bear in the room is dragging everything down. Stocks, bonds, Bitcoin. Spencer, where's Bitcoin right now?
Bitcoin's down 65% on the year.
I think it's trading under 20 grand.
Oh yeah, it's at 19 grand. Last time I looked, as of just a little while ago, it was at 19,000 a Bitcoin. I remember when a client, well, I've had multiple clients call through the years and say, hey, should I buy Bitcoin? And I said, and I'd ask them and say, well, what's it worth? And they're like, well, it's 60,000 a coin. I was like, well, is that really what it's worth? Is that a good deal? And they're like, I don't know. And I think the answer is still, no one knows if 19,000 is a good deal for a Bitcoin. No one has any idea.
All right, now I've got to bring it up because we're talking about it. Bitcoin price right here got as high as, oh, we're on the fly here. Let's go 5 year. Good grief. Got as high as 67,617. Now it's at 19,608. So the big bear is just beating up everything, right? So what's the big bear that I'm talking about, guys?
Inflation, Brett. You're talking about the big bear of inflation. And last time you guys had a great podcast of looking at the last 3 inflationary periods and recognizing a connection between peak inflation and market bottoms. But inflation is the thing that is beating everyone up right now.
So I've heard that inflation has been caused by Russia and by China's lockdown and by supply chains. But no one is really calling it out like it should be. Where is this inflation? And I don't know if we want to put a percentage on it, that might be too hard, right? 90% of the problem, or 85% or 95%. But where did the biggest problem come from? Why is this inflation 8.5% right now, 8.58% right now?
Great question. There's a really, when I really want to geek out, there's a statistic that I love to watch, and I've actually been following it for a long time. It's called M2, and it is a measure of the total money supply in the US economy. Every single dollar that you have, that I have, that everyone has, that's out floating around. And historically, M2 grows anywhere 2 to 4% a year. And that's typically what it's done. And you can see that chart, that purple line you have is M2, and you can kind of see a gradual growth rate along, that's 2014, 2016, 2018. And then all of a sudden you get to 2020, and we all know what happened. Ironically, Rudy Gobert got traded today, and Rudy Gobert was like the domino that ticked like COVID off. Do you remember that? He tested positive at Oklahoma City, and the whole world that was the first domino to fall, and everything fell apart. Well,
Spencer ties everything back to basketball, bro.
Yep, that's exactly right. Well, you can see something interesting. So when COVID hit, which is that purple line, M2 is the purple line, the yellow gold line is inflation. But COVID hit, the government shut the economy down, and what did they do? They pumped a whole bunch of money into the economy to try to keep things alive, keep businesses alive, keep households, whether it be PPP loans, whether it be child tax credits that they actually started mailing checks to people, all of those things came into effect during COVID. And in 2020, you take a normal growth rate of M2 of 2 to 4%, and all of a sudden, 26% more dollars were in circulation at the end of the year compared to the beginning of the year.
And that was in 2020. And then you add
more
more
12% to where right now you have 40% more dollars in circulation than you did 2 years ago in February of 2020. And so for sure, the war in Russia is affecting inflation with energy prices and stuff. And for sure, supply chains and shutdowns in China with manufacturing and not being able to get goods. All of those variables are impacting inflation and having a negative impact there. But the elephant to go along with the bear is the fact that there's 40% more dollars floating around in the economy, and there's not 40% more goods and services. So you have a lot more dollars chasing the same amount of goods and services. What has to happen? The prices have to go up. And that is ultimately the driver behind this inflation.
You can see on that chart you're referencing the inflation rate following that M2 after the lockdowns ended.
Yeah, it was, and you can see prices went down immediately because everything got shut down. And so anyone was lowering prices to try to sell goods. But once, and inflation is always, a lag. It's going to lag the money supply. The money has to get out into the economy first, and then the prices are going to rise. But you can see that line exactly. It was a bottom, and that's when the money supply really increased. And then all of a sudden, what happened to inflation?
It took off.
Yeah. This is the printing press at work, right?
Yeah.
and we don't printing presses. This is what's happening.
And we don't we don't like the blame game, right? Like we're just not those kind of people that like to blame stuff on others. But the government completely overreached here. And was it the second stimulus, or, how many stimuluses were there? Was it the PPP and just giving money to all these businesses? Was it the checks that they sent people? All that. There's just way too much money sloshing around the system right now.
Well, and I think, Brett, it's important, like looking back, and there will be case studies on all of this, but there's always a cost to everything, and I think people immediately think money as a cost, but there's just consequences and a cost to everything. And with well-intended, policy of trying to keep businesses and open and everything, well, now we're paying the cost for it. I mean, that's honestly what it is. Now the piper has to get paid, and inflation is really the cost for all of that government stimulus. Rightfully, wrongfully, that's just a natural consequence of what's taken place. And so the pain of it is being felt every time you fill up with gas or do anything else, just because those prices have increased so much.
Go to the grocery store, whatever it may be.
One other thing I'd say, you don't hear a lot about modern monetary theory anymore, which was that, there's no repercussions for money just flooding the economy and giving everyone money. That's the modern, isn't it? That's what it's called, MMT, modern monetary theory. That was 3 years ago, pre-COVID. There were a lot of people saying, hey, the government just needs to print more money and give more money to people. Well, you don't hear that much now, because now they're seeing this is what happens when you do that.
That's why they call it a theory. They kept, they think that you can just print and no consequences. Inflation won't come up, and how much debt the government has doesn't matter. There's no, and now we're seeing that there is a cost to everything that's done and has been done.
Yep.
So before we talk about why inflation is so bad on a portfolio, which we want to illustrate, we got inflation at 8.58. Brian, when's the pain going to stop? I mean, it's been 7-8 months.
Yeah.
Like, uncle, I'm tapping out. When?
Wait, wouldn't that be nice? Wouldn't that be nice to know? Wouldn't it be nice to know that when this would end? Just put me in a deep sleep and then wake me up when it's over. That's what I'd like, or at least let me know when it's going to end and how this inflation is going to end. Yeah, unfortunately, we don't know. How it will end. I think it absolutely has to end. The cost of inflation is so detrimental to our purchasing power over time. And we have to do what's needed. We have to take some hard medicine right now, and some medicine that doesn't taste very good. And there's going to be some side effects to that medicine. And we're seeing that right now with higher interest rates are as a result of high inflation. I mean, that's why interest rates have gone up. That's why the 30-year mortgage has gone up over 5%. I think it hit 6% briefly there. So that's the cost of some of the actions that we've taken over the last couple of years.
So the next, go ahead.
Can I say one thing, Bretter? Just on the education side as well, we've explained why this inflation has happened, and though we don't know when the inflation will end, we know what will cause it to end, and what will cause it to end is a slowing in the economy and less growth of the money supply. That purple line that you have, that chart, that has to flatten out, and the way that flattens out is that there's less lending going on, less private bank lending out into the economy. And the way that the Fed is trying to encourage less lending into the economy is by raising interest rates, making it less attractive to borrow money, and also them paying the banks a higher interest rate to hold on to their reserves. So that's why the Fed is raising the short-term interest rates. They're trying to make it more attractive for banks to hold on to their money and less attractive to lend it out, meaning there's less people that want to lend it out. But that is how inflation will come under control. When that happens, no one knows that, obviously.
You've heard the term that the Fed is going to shrink their balance sheet. I mean, that's what we're talking about. Over time, they're going to shrink their balance sheet, pull money out, pull reserves or money out of the system, and it's in the process now, but it's going to take some time.
And this year, just so data point, so far this year, M2 has grown by about 3%. So far just this year. So that's where, the most recent numbers on June 28th, in May, M2 grew by 0.1%. It actually went down a little bit in April. And so we're on track to be under 6% on the year, and that's a good sign.
That's because going back to a few podcasts ago, we're currently in a recession. Just kidding, Brian.
Good debate. That's a good debate.
So,
well, Brett, I mean, there's a decent chance that we'll technically hit a recession, maybe this upcoming quarter. I mean, there's a decent chance of that. 2 negative quarters in a row is the definition of recession, but
50-50 shot. Yeah.
Just for our listeners, Brett thinks we're in a recession. Brian doesn't think yet we're in a recession, and I'm right.
And you're trading Louis Gohmert to University of Pennsylvania. So the one thing with inflation that I will say before we talk about its impact on clients is you've seen over the last 2 months, wheat collapse, lumber collapse, soybeans collapse, beef collapse. Like all of these commodities, with the exception of oil, are collapsing in price. Is that enough for me to proclaim that we've hit peak inflation? No, but it is definitely some positive signs that people are slowing their spending, which is what Spencer just talked about, which is what needs to happen. So
you're also seeing, like Target said a month or so ago, said that their inventories are building. I think Walmart said the same thing. So you're seeing some deflationary indicators out there already in some sectors.
Absolutely. You're going to have 2 Prime Days this year instead of 1 with Amazon. Why? Because they have so much inventory, because everyone stopped buying. So yeah, you are seeing some positive signs of things slowing. So let's talk about inflation and why it's such a negative thing for people in building their wealth. And the best way to do that is to look at a compound interest calculator. And I call inflation the greatest risk for wealth destruction. It's the cancer that slowly kills people's wealth over time. And what do we mean by that? Well, here's $1 million portfolio, the inputs on our left. No, we're not doing any regular deposits. And it's a 10% return over 30 years. Okay. Now, a 10% return is the return before inflation. So before inflation has an impact on this portfolio, your 1 million at 10% over 30 years becomes 17.5 million, which is awesome. That's great. Well, if inflation is normal, you're running about 2% inflation. So a 2% inflation rate, that takes that 10% return down to 8. And so what's the impact of 2% inflation? Well, it goes from 17 million to 10, which is crazy in and of itself. Right? That's 2% regular inflation. Okay. So what if we don't get this inflation under control and inflation remains high, elevated for way too long? And I'm saying maybe 6% inflation rate. Okay. So that would, a 6% inflation rate would take your 10% return down to 4. So what impact would 6% inflation have over time on a portfolio? 3.2 million. Like, that's crazy. That is what, and Spencer, in your financial planning, your planning meetings with people, as you build that financial plan for them, inflation's a huge component of that, I imagine.
Oh yeah, absolutely. Inflation is, that's where a lot of times people, when we sit down together and they think maybe they're a little in better position than they are, because a lot of times they'll just do an Excel spreadsheet and they'll say, okay, for the next 40 years, we're going to live off of $8,000 a month or $10,000 a month. And it's great. And what they're not accounting for is that $10,000 a month, 30 years later is actually $25,000 a month, because of that inflation. And so, yeah, you can see right there, if inflation persisted for an extended period of time, someone just lost $14,000 worth of purchasing power, in your example. That's enormous.
That's how someone goes from a comfortable retirement to having to get a job in retirement when they don't want one, is because of that kind of impact. And so, Brian, you and I were talking a little bit earlier about whatever we need to do, whatever needs to happen to cure us from this inflation cancer that's running rampant right now. Whatever needs to happen, great, so be it. What do we mean by that? Summarize what we were talking about.
Yeah, I mean, we really have to take care of inflation. That is, like we've said, it's so detrimental to our purchasing power, and it's so we have to take some hard medicine for sure, and that means possibly a recession. And if a recession will slow the economy down and also get inflation back to a reasonable level, the target is 2% inflation long term. Right now we're running at 8+%. We're a long ways away from 2%. So it's going to take some time. And does that mean, one of the things we talk about inflation, I've heard this a few times, one of the cures for high oil prices for them to go down is high oil prices, and that will slow the economy down and hopefully put, slower demand or lower demand on oil prices.
Yeah.
So, yeah.
So if it's a recession, bring it on.
Bring it on.
If it's higher interest rates, bring it on. If it's whatever to get us to cure the inflation, to get us back to that 8%, whatever we need to do, we got to do it.
Well, so if we have a recession, that's a temporary thing. Of course, having a long-term recession that, sticks with us a long time, nobody wants that. And nobody wants a short-term recession. But the hope is that we can have that maybe a recession might bring down, a short recession might bring down inflation and bring down prices. And if that's the medicine we need, then, I think that we need to be willing to accept that. What we can't have is long, durable inflation that sticks with us and just destroys purchasing power over the long term.
Yep. You know what the other good news is, Spencer?
What's that, brother?
Got some great news for you.
I'm excited.
On the other side of every bear market is what?
I tried to make Brett cheer Brett up the other day by letting him know that 100% of all historical bear markets have ended with a bull market. And I think we can all say that we're confident. There are no guarantees in this world, but all three of us are very confident that this bear market will do the exact same and end with a bull market. And we look forward to obviously working through this bear market and recognizing that sometimes these are painful, but we look forward to the new bull market that will start when it does. If that's 3 months from now, or 7 months, or 12 months, but they've always ended with a bull market.
That's a good way to put it, Spencer. It'll happen when it does. Here's a quick chart, Brian, that you sent me a little bit earlier today. And I'm going to focus on the far right column because we're long-term investors and we buy great businesses and we're looking out 3, 6, 10, 20 years. After every 20% drawdown since World War II, okay, which we are currently in, the average return 6 years later, you're up on average 79%. That's the good news, is when this ends, whenever that ends, there's a nice bull market to take advantage of on the other side. So, Ryan, cheer up.
Yeah. I mean, even 1 year later, if you look at every, bear market, just 1 year later, on average, you're up 17%. Once you go down 20%, you're on average. Now there's, 4 instances where you're still down a year later. We've talked about this many times in the past, how basically another way that I've said many times in the past, every market downturn has been temporary. We've never had a permanent downturn in the market. And just as Spencer said, every bear market ends with a bull market. And I'm confident that will happen. We don't know when it will happen, but I'm confident that owning a good business over a long period of time will be a good way to fight off inflation, build wealth, accomplish your goals.
Yeah, well said. What we need is that elephant that's in the room with the bear to just step on it and squish it, and we'll be done, right? And then Rudy Gobert will come clean up the mess or something. Anyway, the best part about this podcast is that it is July 4th weekend. And so as we round out and end this podcast and we welcome the first part of July, which we love, let's say thank you to all those that have served our country that make it possible for us to celebrate a July 4th. And we want everybody to have a fantastic July 4th holiday. So with that, my friends, until next time, when we should be in the same room together, enjoy your holiday. Talk later.